This video will cover the determinants of interest rates. We'll look at real interest rates, we'll look at the inflation premium IP, default risk premium DRP, the liquidity premium LP, and the maturity risk premium MRP. We'll throw them all into the kitchen sink, and that's why I refer to the equation you see below as the kitchen sink model. It says the nominal interest rate on a bond equals the real rate of return plus an inflation premium plus a default risk premium plus a liquidity premium plus a maturity risk premium. Which one of those premiums is applicable depends on the type of bond we're looking at. Then we'll investigate what exactly do these premiums represent. And that's what we want to look at next. Let's study this kitchen sink model a bit more to get some intuition as to what really are the determinants of interest rates. So what we want to do is look at the full equation now. This full equation applies to a long-term corporate bond. Long-term meaning over 1 year, and corporate bonds issued by corporations, not the U.S. Treasury or a municipality. And let me go over each one of these components. Now again, this is the real rate of return, and this is an inflation premium that represents the average expected inflation rate over the life of the bond. So I'm going to show you an example of a 3-year bond, right? This is going to be the interest rate on an annual basis for a 3-year bond. This is going to be the annual real rate. This will be the average annual inflation rate over the 3 years. Then we'll look at a default risk premium, and that'll have to be given to you. Either you back into it or it's given to you. The same with the liquidity premium. It's either given to you or you have to back into it. And I'll show you what I mean by backing into the numbers. And then we have a maturity risk premium. So let me cover default risk premium here, the concept of what it represents. The default risk premium represents the extra return that you want on your bond for taking the risk that there's a probability of the corporate bond defaulting. So what we mean by default is you're not going to get your principal back nor the interest payments once the bond defaults. Basically, the company goes into bankruptcy. That's what we're going to assume here. So corporate bonds can default, but we assume that treasury bills and treasury bonds do not default. So the default risk premium for treasury securities is going to be 0. It just wipes out. It's not there. So that represents a risk premium associated with the probability of default. And the probability of default for corporate bonds, it's above 0. Keep in mind what we mean by treasury securities not defaulting basically says the U.S. government will not go bankrupt. The next term here is liquidity premium. Bonds notoriously have low liquidity. They're relatively illiquid, especially corporate bonds. Okay? Treasury bonds, on the other hand, are the most liquid markets in the world. So when you're looking at a treasury security, LP, the liquidity premium is 0. What do we mean by a liquidity premium? Well, it's basically this. It's a risk premium so that it gets added onto this nominal rate. It's a component if the bond is illiquid. An illiquid bond is a bond where you have to discount it or drop the price significantly to sell it. It's kind of like a house. A house is very illiquid, and if you want to sell your house immediately, you're going to have to drop the price below fair value to sell it, to get a buyer quickly. Compare that to an ounce of gold. An ounce of gold, you can go anywhere and sell it pretty quickly because it's easy to interpret, easy to measure, and there's little risk associated with the actual sale. So gold is a very liquid market. The same with oil. But in the bond market, for corporate bonds, there could be substantial liquidity premiums because the bonds don't trade that often. That's one reason why there's a liquidity premium. Your house, for example, doesn't trade that often, and so people really have to do a lot of analysis, figure out really what it's worth. Whereas gold, it's almost a no thought process for people who deal in gold. So the point is, bonds, corporate bonds, frequently do not trade, and that's the problem. That's why there's a liquidity premium associated with those bonds. Now, bonds that have a maturity of over 1 year have a maturity risk premium. So if you have a bond that's 1 year or less, there's no maturity risk premium by assumption. There's a formula for this that's often used in the book, and it's this. this maturity risk premium equals 0.1 times T minus 1. So you put in T is the number of years. So if you have a 1-year bond, this becomes 0. You have no maturity risk premium. So this only applies to longer term bonds. Now, if you have a long-term treasury, this applies. These two terms wipe out. If you have a long-term treasury bond, then you still have this maturity risk premium. And what does the maturity risk premium represent? Well, as you can see, as T goes up, the maturity of the bond goes further and further out in time. What that means is the bond becomes riskier. People are hesitant to tie their money up for, 5, 10, 20, 30 years because they don't really know what's going to happen in 5 years, 10 years, or 30 years. They just don't know. And so the further that you ask them to lock their money up in a long-term bond, the higher this maturity risk premium. And that's what this formula is telling you. As T goes up, this maturity risk premium is going to go up at 0.1% per year. Keep in mind that these maturity risk premiums are way more complicated than this simple formula. And so this is just a formula so that you recognize the fact that when maturity goes up, the maturity risk premium increases. Also keep in mind that the textbook often does not use that formula for more maturity risk premium. They at times just give it to you. It's just a given. So let me give you an example. I'll start out small and then we'll build up to a bigger and bigger problem until we incorporate and use the entire kitchen sink model. So let's suppose that we have a treasury bill. Treasury bills are usually 1 year or less in maturity. And we're going to look at a 3-month treasury bill. So it's T 1 quarter of a year. And be careful, that capital T stands for treasury and the 1 quarter stands for the time, 1 quarter of a year. Yeah, it can be a little confusing because sometimes we designate T as maturity of the bond, but when you see it next to an R, a little r here, and it's a subscript, T represents a treasury, and this is a treasury with 1 quarter of a year maturity. And we're going to assume that that nominal rate is 3%, and we're going to assume that the real rate of return is 1%, and then let's back into the inflation premium. Well, it's going to be R equals R star, and this is T 1 quarter, plus IP. This is 3 equals 1 plus IP. The inflation premium is going to be 2%. Okay, not so bad. Now, the important point to remember is, look, you have a bond, and here is 1 year. And this has a 3-month maturity, then there's 6 months, and then there's 9 months, and we end up with 1 year. So this bond covers this time frame. So what we're looking at here is a bond that has an annual rate of 3%. The actual rate of return that you're going to earn from holding this bond from here to here is going to be 1 quarter of this 3%. In other words, you're going to get 0.75% here, and then if you could roll the bond over, so you buy it, and the bond matures, and then you roll it over, meaning you invest again, then you'll get 0.75% in this time period. You roll it over, you'll get 0.75% in this time period. And you roll it over, you get 0.75% in this time period. In 1 whole year, you would get 3%. So remember, interest rates are almost always disclosed on an annual basis. So that's what this 3% is. The point is, you're not going to earn 3% in 3 months. That would be very high, especially in today's world. Okay, so you're only going to earn 0.75%. And the other thing is, see this inflation premium? The inflation premium is annualized and counts only over the first 3 months. Because remember, IP is the average inflation rate over the life of the bond, and it's at an annualized rate. So now, just to be sure, what would be the rate of return that you would earn on this bond? Here, well, just to reiterate, you're going to earn 0.75%, this 3% divided by 4. And that's going to equal that 1% divided by 4 plus the 2% divided by 4. And when you get done, this is 1 quarter plus 1/2, and we get 0.75%. And so that's how treasury bills work. Now, let's build up the model so we start looking at other variables. So notice what happened, by the way, before I get in there. Here's the kitchen sink model. This was a 3-month treasury bill. I looked at R-star, we looked at IP. There's no default risk premium because it's a treasury bill. There's no liquidity premium because it's in the treasury market and they're the most liquid securities in the world. There's no maturity risk premium because this security is under 1 year. So all of this washes away and we just dealt with this part of the formula. Now, if you were to look at a long-term treasury, so instead of this being 1/4 of a year, we looked at a 3-year, then this formula applies plus this term because now security matures in over a year. This maturity risk premium applies to a 3-year treasury bond, for example, but these two guys are going to be 0 because they're highly liquid and there's no default risk. So now let me give you a more involved problem. As I said, I'm going to ratchet up the difficulty a bit as we go. And so here we have a pile of given information. We have the return for a corporate 3-year bond. See, C stands for corporate. It's a subscript there. 3 stands for a 3-year bond. That nominal rate is 6%. The return on a 3-year treasury, see T for treasury, 3 for 3-year, is 4.2%. The inflation rate over the next 3 years is going to be this series of information. Inflation for the first year is 2.5%. The second year, and if you can't read that, that should be a 2, is 3%. And the inflation rate for the third year is 3.5%. And as I said before, the inflation premium is the average of the inflation rates over the life of the bond. So it's a 3-year bond. We're going to average 3 years worth of inflation rates, and that'll be 3%. You don't even need a calculator to see that the average is 3%. Now, let's calculate the maturity risk premium. In this situation, they're giving you a formula. As I said before, not always the case. We may not get a formula, and it may not abide by this calculation. They just give you a formula. You have to back into the number somehow, some way. Now, since it's given, let's plug in the information. 3 years minus 1, that's 2 times 0.1. The maturity risk premium is 0.2%. Default risk premium is 75, 0.75, 0.75%. The question asks for what is the real rate and what is the liquidity premium. Okay, find those. So the first thing we need to recognize is, look, let's start off with the little model here, this guy. Because we're given this number of 4.2%. We're looking for R star. And the IP, we basically have it here, almost given to us. And the maturity risk premium was basically given to us. And so when we do this calculation, we see that R star equals 1%. Okay, so what we did was we used that smaller formula for the treasury bond. Now that we have this information, let's plug it into RC3. That's going to equal, I'm going to watch it, don't run into some space, run out of space here. And this is going to be 6% as given. We just calculated the 1%. Now keep in mind that in these problems that we're seeing, the opportunity cost of money is the same regardless of the bond because that's the place where you can put your money. Your money can earn 1% somewhere else. So the next best alternative was 1%. And it applies to both bonds. So it applies here. It's going to apply in this corporate bond. The inflation premium, since it's a 3-year bond on both sides, both 3 years, it's going to be the same inflation premium of 3%. The default risk premium is 0.2, as we calculated here. The LP, we don't know. That's what we're solving for. And the maturity risk premium, oops, right here. The default risk premium is 0.75, and the maturity risk premium is 0.2. Now, solve for this, one equation, one unknown. You do the algebra, and LP equals 1.05%. So that's our liquidity premium for the corporate bond. Let's work another problem. The problem reads as follows. An investor in Treasury securities expects inflation to be 2.1% in year 1, 2.7% in year 2, and 3.65% each year thereafter. Okay, given that information, INFL1 is 2.1%, INFL2, inflation rate for the second year, is 2.7%, and INF3 through to the end for however long, because it says basically thereafter, is going to be 3.65%. Okay, hold that information, and it says here, assume the real risk-free rate is 1.95%, and that this rate will remain constant. The 3-year Treasury security yield is 5.2%. So the Treasury for 3 years is 5.2%. And a 5-year Treasury security will yield, RT5, yields 6%. What is the difference between the maturity risk premiums on the two securities? And so we'll have maturity risk premium 5, right? And then we'll have maturity risk premium 3. And it's asking what is the difference between these two? That's what we want to solve for, that difference. Now, that looks kind of hard, but let's first get a handle on what we're doing here. Let's first take this information and compute IP3. And that's pretty easy because it's just the average of these three numbers. And so IP3 is 2.81%. Now the question becomes, what is IP5? Okay, well, let's do a little timeline here. Here we got 5 years. It's going to be 2.1% here, 2.7, 365, 3.65, 3.65 here. And so it's going to be the average of this. So you could just literally add this up and divide by 5, where you could say, especially if you go out 30 years, for example, this is going to be a pain. So you could do it as 2.1 times 1/5, because it's just a weighted average of these. It's an equal weighting, 1/5, one for each year, plus 2.7 times 1/5, plus 3.65 times 3/5. And when you do that calculation, you'll get 3.15%. Okay. Now, the next trick here in solving this problem is like they're giving you this difference. They're not giving you what MRP is and for the 5-year security and for the 3-year securities. They're giving you the difference. So sometimes this is what's helpful, this concept here. We take RT5 equals R star plus IP5 plus maturity risk premium 5. So this is an inflation premium that averages 5 years and a maturity risk premium for a 5-year security. And then we're going to subtract it from a 3-year security. When we subtract that, this is the difference between the two interest rates. It's the difference between these two numbers. It's going to be 0.80. Okay? This will cancel out, so we can ignore it. And then the difference between the two inflation premiums here, this inflation premium, which is IP5, and here, the difference here is 0.34%. And then the difference between these two, that's this guy right here, is what we're solving for, has to be this. I'll just call it change MRP. And that has to equal 0.46. And then the questions, so once you solve for that, that's what the problem's looking for. It's like, great, we solved it, but how do you know? How can you be sure and comfortable? So here's what I would do. Get some space here. I would take R T5 equals R star plus IP5 plus maturity risk premium 5. We know this is 6%. We know this is 1.95%. We know this is 3.15, and so the maturity risk premium here has to be, this guy right here, has to be 0.90. And then doing the same thing for the 3-year security, this is 5.2, 1.95 plus 2.81. And this guy right here, what's missing, is going to be 0.44. So the difference between 0.90 and 0.44 equals 0.46. Exactly what we solved for. So the trick is sometimes realizing that you can subtract these two equations. It sometimes becomes very helpful if you have, say, a corporate bond that, a return on a corporate bond that's 10 years, and it's going to have R star plus IP for 10 plus a default risk premium plus a liquidity premium plus a maturity risk premium 10. And then you can look at a treasury for 10 years, and the treasury return will be R star, it'll be this. There'll be no default risk premium, that'll be 0. Liquidity premium will be 0, and you'll have a maturity risk premium of 10. But realize the maturity risk premium for a 10-year security and the maturity risk premium for a 10-year security, it doesn't matter if it's a corporate or a treasury, they're the same thing. So the difference then is RC10, RT10, these cancel out because the risk premium for a 10-year period is the same regardless of what security. Cancels out, we get default risk premium plus the liquidity premium. So let me move this up a bit. And this says the difference between a 10-year corporate bond and a 10-year treasury is the default risk premium and the liquidity premium. So when you have the same maturity securities, the difference between a corporate bond and a treasury is going to be these two components. That's an important insight. It'll help you possibly, depending on the setup of the problem.